Let's calculate some depreciation. Remember, we need to know three things to calculate depreciation: the cost of the asset, the salvage value of the asset, and the useful life of the asset. To calculate straight-line depreciation, we first take the cost of the asset and subtract the salvage value. This is called depreciable value. This is the most that can be depreciated for this asset and is the total amount that can be depreciated if the company keeps the asset for its entire useful life. Next, we divide the depreciable cost by the asset's useful life. The amount that is calculated is the depreciation expense for 1 year. Let's walk through a calculation with some actual numbers. Assume we purchased a piece of equipment on January the 1st, the beginning of our company's fiscal year. The equipment cost $30,000 with a salvage value of $2,000 and a useful life of 7 years. On December the 31st, how much depreciation should we record for the year using straight-line depreciation? To determine this, we will use our straight-line formula of cost minus salvage divided by useful life. The equipment's cost is $30,000, the salvage value is $2,000, and the useful life is 7 years. That comes to $4,000. What does this $4,000 represent? This is 1 year's depreciation. Therefore, we would make an entry on December the 31st to debit depreciation expense for $4,000 and credit accumulated depreciation for $4,000. Let's assume the same information, except we issue financial statements monthly instead of annually. We need to make our depreciation entry at the end of each month. How much depreciation would be recorded at the end of January? We already know, based on our straight-line formula, that annual depreciation is $4,000. This is for 12 months. To make this into a monthly depreciation, we just divide it by 12. So, we would record approximately $333.33 each month. At the end of January, we would debit depreciation expense for $333.33 and credit accumulated depreciation for $333.33. This is so fun! Let's do one more! Same equipment and same information with one exception. We didn't purchase the equipment on January the 1st, but on April the 1st. If we only adjust depreciation once a year, would this change anything? Let's go back to the drawing board and look at our straight line equation again. Cost minus salvage divided by useful life. So far, everything is the same. But remember, what is the number the formula calculates for us? It is the annual depreciation amount. So, if we didn't have the equipment for 12 months, we would not record this amount. How long did we own this asset this year? April 1st through December the 31st is 9 months. We can only record 9 months of depreciation this year. To determine this amount, we can take the $4,000 and divide it by 12 to get a monthly amount. We already know what this is from the last example, right? The monthly amount is still the same as well, $333.33. The only thing that changes is how many months this year we can record. Instead of recording 12, we only record 9. That totals up to $3,000 this year. If we only adjust depreciation at the end of the year, our entry would be a $3,000 debit depreciation expense and a $3,000 credit to accumulated depreciation. Now, wasn't that fun? Depreciation is a blast.